When I invest in dividend stocks, I have a very distinct set of filters that I put each individual opportunity through to make sure it is the type of stock that would meet my goals. Namely, it needs to provide attractive income, it needs to be income that grows over time, it needs to be dependable income, and ultimately it's got to be able to deliver total returns within my target threshold, and therefore be one that once it reaches my fair value estimate, I can sell it and recycle it into an additional opportunity within my Roth so that I get the tax shelter, but also can get the total returns and continue the compounding process. That way, that gets me both closer and closer to my total return targets, as well as my sustainable passive income. So with that being said, in today's video, I'm going to deep dive into how I analyze individual stocks, and then I'm going to share one sector of the market that I think is particularly attractive for finding these kind of opportunities today. I hope you'll stick around to the end because that's where you'll hear my best picks of the moment. Now, if you like this type of content, please give this video a like and subscribe to my channel for more content like this. Also, I'm going to be sharing in the top pinned comment, as well as in the video description, a free list of all the dividend kings at the moment. And these are some of the best dividend paying stocks out there that you can get a full list of to begin building your own portfolio with dividend stocks. I also have a whole bunch of other goodies in the video description, a lot of them free. So please check those out and make use of the ones that can help you on your journey to building passive income from dividends. All right, now let's get into the content. So what is the deep dive that I put each stock through? Well, it's really a 5-filter checklist. The first one is, does it have a durable and defensive business model? And the reason that this is so important is, first of all, the durability is essential, especially in today's world where AI and technology in general are exploding. I don't want to invest in a business that, even if it looks good today, is likely to be disrupted 3, 5, 10 years down the road, because if that happens, the cash flow is going to plunge and the dividend is going to inevitably be cut. And that's a horrible way to invest, as a sure way to light your money on fire. Now, the defensive side is a little bit less of a strict requirement, but it's still the vast majority of my holdings. I want to meet this requirement. And the reason for that is, if you want stable rising dividends, if your company is highly cyclical, highly exposed to economic conditions or even industry conditions, that means that during downturns, when they inevitably come, your income's going to plummet, the leverage ratio is likely going to rise, and the company's going to be forced probably to cut their dividend. And so that's a risk that I generally want to avoid with the vast majority of my picks. I will occasionally invest in some cyclical stocks because those ones can generate tremendous returns in a short period of time if you time them just right. And so ones that I think offer an attractive risk reward, I will invest in, but I always keep them a small minority of my portfolio for that reason. Instead, I focus on defensive business models that pay stable cash flows over time. So think triple net lease REITs, highly contracted infrastructure, utility, pipeline type companies, alternative asset managers that have a lot of permanent capital, or at least long dated capital, business development companies with a lot of senior secured first lien loans can meet that requirement, other forms of fixed income as well, and so on and so forth. Certainly, even you could say gold bullion leases, which, by the way, I have a link to in the video description if you want to learn more about those. But those are another great way because it's contracted passive income from owning gold bullion, which also tends to be quite defensive. So that's a big requirement that I put it through. What's another one? Well, it needs to have a strong balance sheet. The vast majority of the time that I've been burned as a dividend investor, and I see others getting burned, is when they don't, or I don't pay enough attention to the quality of the balance sheet. And this is because a company could have a great business model, it could be durable, it could be defensive, it could have plenty of cash flow that's covering the dividend, but if its balance sheet is over leveraged, there's a high risk that it's going to have to cut its dividend eventually. Even AT&T, which was growing its dividend year after year, strong defensive business model, investment grade balance sheet on paper, had a very durable business model, attractive yield that was well covered, but because the leverage ratio got too high in an industry that had high capex requirements to stay relevant, it decided to cut the dividend in order to be able to free up more cash to strengthen the balance sheet and to invest in the business to turn it around. But of course, probably the most infamous example of this is the late NextEra Energy Partners. It was a great business, still is actually, has wonderful assets, well diversified, renewable power generator, long duration power purchase agreements with investment grade counterparties, generated a lot of cash flow that fully covered the distribution. And so all seemed fine, right? Cash flow's covering it, it's defensive, it's durable, high quality counterparties. What's the rub here? Well, it had a very over leveraged balance sheet with all some of these complicated equity / debt obligations coming due. And it was just this wall that was coming towards it very rapidly. It was having to refinance debt at much higher interest rates than it did previously. And so not only did it cut its distribution, actually outright eliminated it for years into the future. And instead is having to use all of its cash flow to try to fix its balance sheet and sustain its business model. And so that's a classic example. Of course, the unit price plunged plunged as income investors fled the stock. So, that's a great example, or I should say tragic example, that I saw. It was like a slow-moving freight train in real time. I saw people I lost some money on it. I got out plenty early, though, to avoid the worst of it, but others got absolutely hammered with that stock, and it's definitely not one that you want to repeat. And so that's why the balance sheet is so important. Okay, what's the third thing? Well, it's got to have a sufficiently high yield. That's pretty straightforward. What's your target yield? Well, you got to know for yourself. Generally, for myself, I like to target a weighted average yield of between 6 and 8% for my portfolio, but I'm willing to dip down to 3 or 4%, or even occasionally a 2%er, just depending on what the growth opportunities are for that company, how much diversification adds, how compelling the investment is otherwise. But I like that high weighted average yield, not only because it gives me a good stream of passive income that gets me closer to what I would need to cover my living expenses and just more cash flow that I can use to reinvest in attractive opportunities, but it means that I'm not leaning so heavily on growth or even capital appreciation to drive my total returns. Instead, I'm simply just looking at what is the cash flow stream it's paying me, and then if I'm getting a 6, 7, 8% yield, okay, I don't need that much to meet my a reasonable return threshold. I just need a little bit of growth, a little bit of valuation multiple expansion with some opportunistic capital recycling, and I'm well on my way. So just that 6 to 8% yield gets me roughly halfway to my roughly 15% annualized target rate of return. But because of the growth, I often am more conservative on that. The valuation, I'm very conservative on, and I can opportunistically recycle capital. My total return ends up being closer to 15 to 20%. Okay, and the last two ones are pretty straightforward as well. Is the dividend sufficiently covered by cash flow? And again, you got to be careful there, because maybe it looks fully covered, but if it's like, say, for example, a WP Carey had to do this recently, or even Easterly Government Properties had to do this, where higher for longer interest rate environment had suppressed the stock price, had boosted their cost of debt, and so to fuel growth, they couldn't, because they couldn't issue debt, they couldn't issue equity, or they could issue debt, but they didn't want to issue too much because of leverage constraints, and they didn't want to issue equity because their valuation was below their underlying private market value, so it would not have been accretive. And so the only other solution to free up equity to fuel growth would be to cut the dividend to free up more retained cash flow. And so they both elected to do that. And so that's why you want to make sure there's plenty of cash flow available, especially if it's a more capital intensive business like a REIT. You want to have that extra cash flow that's being retained to help drive growth down the line instead of having to make a cut to then get to that point. Otherwise, there are some exclusions to that. For example, like alternative asset managers like Blue Owl Capital or Brookfield Asset Management. They don't need to do that. They're growing through fundraising, which is more of an organic growth, capital light growth model, and so they can return almost all their cash flow to shareholders. And so that's just something you got to keep in mind. And then of course the last one is, what is the dividend growth profile? Now, is it going to grow at a rate that meets or beats inflation over time? That's generally what I like to look for. Now, I will make some exceptions if the yield is extremely high. So for example, if it's a BDC or even a REIT that has a high single digit or low double digit yield, I don't need quite as much growth there to justify holding that, because that yield is above my target range, and so I can use that extra yield theoretically to reinvest in growing the dividend. So that's another way to look at it. So those are the 5 things: durable and defensive business model, strong balance sheet that won't force them to choose between that and the dividend, high enough yield to both have a very viable conservative path to attractive total returns as well as to meet your income objectives, sufficient dividend coverage to feel good about the safety of the dividend and their ability to reinvest to drive further growth down the road, which leads to the 5th point, what is the dividend growth profile? Is it going to be inflation beating to preserve the purchasing power of your passive income? So with all that said, now I'm going to talk about where I'm seeing the best opportunities right now. But again, just as a reminder, if you like this sort of content, please give it a like, subscribe to the channel for more like this, and hit that notification bell so that you can get notified when my latest analysis comes out. It'd mean a lot to me. Thank you so much. All right, so where am I seeing these top picks? Well, I think the infrastructure space is really the ideal spot. In particular, midstream is good, and even just AI infrastructure, I'm seeing a lot of good opportunities there. Now, you get exposure to this through some well-diversified funds like the Reeves Utility Income CEF. It's a CEF, like I said, it's ticker symbol UTG. It invests heavily in AI-related infrastructure and utilities, pays out an attractive yield of about 6%, monthly distributions, phenomenal long-term track record of sustaining and growing the dividend and beating the broader market, especially the utilities space. Very well managed, very moderate amount of leverage, so it's fairly low risk. That's a great one. On the midstream side, you can invest in either the Alerian MLP ETF or the Global X MLP ETF. I slightly prefer the Global X MLP ETF. That's ticker symbol MLPA, just because it has lower fees than AMLP, but AMLP is a fine fund as well. Or you can pick individual stocks, which is what I like to do. And my favorite places to invest right now are midstream MLPs. They have K1s. They can be really useful because of the tax advantages that come with K1s. So stocks like Enterprise Products Partners, MPLX, Energy Transfer, Western Midstream, Plains All American Pipeline, Pipeline, and a few others. Those are all attractive. They give you high single-digit to low double-digit yields, which again are tax-deferred because of the K1 distribution format. They also are growing their distributions at rates that meet or beat inflation, in some cases significantly. So that's a really attractive place to invest. If you don't like the K1s, again, go to the ETF, or there are a couple C corporations I really like. There's a Plains GP, which is the ticker symbol PAGP. It's the 1099 issuing economic equivalent of PAA, Plains All American, which I mentioned, or One Oak, which is ticker symbol OKE. It is a C corporation that issues a 1099 tax form. It is on sale. It is by far the cheapest C corporation in my view, with the potential exception of, say, PAGP. There's also Hess Midstream Partners, which is much riskier, and it's technically an MLP, but it issues a 1099. That's if you want a little bit go out on the risk spectrum, but it could deliver really great returns. It's got like a 9% something yield right now, with a 5% plus dividend growth target, plus significant buyback capacity and a pretty conservative contracting profile. The big risk there is it's highly exposed to the Bakken as well as to Chevron, and so those two things combine to make it a little bit riskier. Okay, then on the AI infrastructure side of the space, I love the Brookfield subsidiaries. So whether it's Brookfield Infrastructure, which both has a 1099 issuing its ticker symbol BIPC, or the K1 issuing BIP, and then Brookfield Renewable has the same thing. BEPC is the 1099 issuing, BEP is the K1 issuing, and then of course you can invest in alternative asset managers like Brookfield Asset Management, that's ticker symbol BAM. They have a good amount of infrastructure exposure. And then Blue Owl Capital has a rapidly growing digital or AI infrastructure business as well. That's ticker symbol OWL. I'm not talking about the BDC, OBDC. No, I'm talking about the asset manager OWL. I always get comments about that, people getting confused. It's OWL. It's an alternative asset manager. It's not a BDC. It manages OBDC as part of its portfolio, but it's not the same thing. So anyway, hopefully that adds value to you, telling you both how I look at individual stocks and how I study them to determine the ones that are going to meet my needs, but also which ones I'm seeing right now that really check these boxes and give you a really attractive combination of yield and growth potential, underpinned by strong investment-grade balance sheets, durable and defensive business models that are being boosted by the AI wave, but also highly contracted, so they're more defensive, and they have the good yields, the good dividend growth, and the good dividend coverage ratio. Thank you so much. Again, if you like this, please give this video a like, subscribe to the channel for more, and don't forget the free list of Dividend Kings in the pinned comment as well as in the video description. Thank you so much. See you next time.